Now, tonight we're going to be discussing one of the most dynamic and helpful technical indicators that we have. Okay, it serves many purposes and is not a complex indicator, but can be used and built into a great trading system. Moving averages help traders make effective transactions by aiding them in evaluating the price history of a currency pair or related instrument. More specifically, these averages make it easy for investors to interpret the price fluctuations of an asset by smoothing out their randomness and movements. Now, what a moving average does, it kind of takes the noise out of the market. As we all know, the markets bounce around all day long, moving up and down in all directions. And sometimes you can't see the forest through the trees. Moving averages, or a moving average, will help you see past this. It'll smooth out the price. So technical analysts have harnessed a wide range of indicators over time. But the moving average stands out due to its being simple, practical, and useful. By using it, traders can identify the price trends as well as the support and resistance of the security in question. Now, you can use moving averages in many different ways. Hold on one second here. There we go. There's a little glitch in the GoToWebinars programming, and whenever I go to turn on a marker, it flips a screen, and then you have to flip it back, and it gets back, but we got it all back. Okay. So now a moving average is not complicated. It's pretty straightforward. And it falls into a group of what's called lagging indicators that accumulate past price points and then averages them to provide a technical analyst with a better sense of where a security went over a period of time. Now, when we say lagging indicator, I know in English we have what we call, the kid lags behind in school. Don't lag at the end of the line. We think of the word lagging as a negative connotation. But in the financial markets, it's not a negative connotation. We have leading indicators and lagging indicators. A lagging indicator shows that something has happened and confirms it. A leading indicator tries to predict something that will happen. Okay. So a lagging indicator, like a moving average, uses past price history to let you know what has happened. Okay. Now, there are many different kinds of moving averages, but basically, you just add together several data points and divide them by the number of data points you added together. So if you wanted a 12-period moving average and you're using a 1-hour chart, you would take the close of that price over the last 12 hours, add them all together, divide it by 12, and that would give you your moving average. If you were using a 15-minute chart, you would use the last 12 15-minute periods. It's whatever line is on your chart. If you're looking at a 1-day chart and you want a 12-period moving average, it will be 12 1 days. Now, a simple moving average, or an SMA, is exactly what we were just talking about. Add them all together, divide them by the number you're adding together, the number of price points, and you have your moving average. An exponential moving average, which is extremely common and very well used in our market, gives a little bit more weight or credibility to the more recent action. In other words, if you were using a 1-hour chart and you're using a 12-day, or let's use 10 for an easy number, using a 10-period moving average, if gold was trading at 1250, 1250, 1250, 1250 for all 9 past cycles, and the last cycle it jumped up to $1,300, your moving average might move to 1254. But it's more important that gold just surged up to 1,300 in the last segment. So by using an exponential moving average, it gives more weight to that current price. So and less weight to the older price. So it's all put together, and gold might come out then at 1256 or 1257 because the radical change was in the more recent prices. And there's many different kinds of moving averages. But SMAs and EMAs are the most popular. And most people do use what we call a weighted moving average because they want that little bit of information about the more recent price. So the formula to calculate a moving average is simplistic. Now, this can differ depending on the moving average type that's used. A simple moving average calculator uses the following formula. It sums up the closing values of all the periods considered and divides the result by the period's number. Now, we say closing. Okay. Typically, this is standard throughout the industry. But that doesn't mean you couldn't use the open or all the highs as long as you're using the same thing or the average price, the mid-range price. Okay. You can use any of those. Okay. But typically we use the close. And basically for all the years I can remember back, everybody used the close. But now because we have all these advanced computers and all these advanced charts, we can actually pick and choose what price level we want the moving average to calculate from. Basically, for all of us, we should be using the close. Now, to give a simple example, the exponential moving average is giving more importance to the current price level rather than the closing price of the candles that make the period. Between the SMA and the EMA is much more accurate as it doesn't lag that much. A moving average calculation is not mandatory on closing prices. It applies to various other prices like opening ones, average ones during the day, and so on. The closing prices is the most popular and widely used. So I'm going to pop up a little presentation that I'll share with you on this simple part of moving averages to help you better see it than all my words. Okay, so that hopefully put that in an easier presentation, easier to understand. Now, before we go on to a little bit more about averages, I have to tell you there's a huge selection of averages. So we looked at the SMA and the EMA. These are the two most popular. Okay. We mentioned in the presentation a weighted moving average, but then we have what we call a volume weighted moving average. Now, don't freak out because you never have to calculate any of these. Basically, you go on your chart, and if you want volume weighted moving average, you click on volume weighted, and it does the calc. If you want an EMA, it does the calculations for you. There's nothing you have to do. But a volume weighted moving average is a simple moving average that considers the volume traded during that period. It is more accurate than an EMA, okay, because volume reflects supply and demand imbalances. Knowing when and where big players are buying and selling often means knowing when a new trend will start or end. So it calculates in the volume for the period also. So it combines the price with the volume in a complex little formula, but it helps you see some more distinct market action. Because the retail size of the Forex market is small. It's barely around 6% of all the daily transactions in for the overall Forex market. And we're talking about retail. Retail is you and I trading on platforms. Okay. So to put this in a perspective, consider that the Forex market is $5.5 trillion per market in the market per day. Okay. Now, we need to see the volume, or the volume is critical in knowing when market participants other than retail traders, like commercial banks and central banks, Forex brokers, liquidity providers, buy or sell. So it acts as an indicator that shows real direction of where the market is heading. So the volume is irrelevant in many Forex trading because any volume indicator offered by a broker shows only that volume traded at that broker. And that used to be true. It isn't. If the broker is getting feeds, which like ETX does, those feeds also include all the volume being traded. Okay, so you're getting all the data. It used to be a long time ago that if the volume was only being calculated on what the broker had because they didn't have those feeds coming in on their charts. Today, you have all the accurate information. Now, there's a couple newer ones. Displaced moving average. This is a relatively new concept in technical analysis. A displaced moving average indicator, DMA, is nothing but a simple moving average. So let me explain why. Traders found that multiple time frames is slicing through various SMAs like there is no resistance and support. Then we see the price reacting from lower or higher levels. So to overcome this, okay, and this fact that it's a lagging indicator, we cheat a little bit. How do we cheat? Okay, we take the current moving average, the simple moving average, and what we do is we push it forward a number of time periods. So in other words, if you're looking at a 1 hour chart and you calculated the DMA, which is just an SMA, for the last 10 hours and came up with that number, instead of plotting it at that precise moment, you push it forward and it'll plot it on your chart a little bit forward. Okay, so I'll show you a chart in a second that has it, and I'm going to also show you how you can do it on ETX. So the results are fascinating. Important support and resistance areas result using the same moving average, meaning only that a small trick influences the outcome. So what as you can see on this little chart to the right, here we go again. Okay, let me get my marker back on here again. Okay. As we see on this little chart to the right, the SMA is here, is the blue line. Okay, and we would normally calculate and put the price on the chart right there. But in this case, we're pushing it forward and we're dropping that price here. So the SMA line or the DMA line is actually in front of prices because price hasn't reached this point yet. And it gives us some interesting results. It's a fairly new concept and is something you might want to check out. Now, once a trader has calculated one or more moving averages for security, a trader can use it for a wide range of purposes. Many traders or investors utilize these indicators to determine what trend a security is following. Now, I need to explain to you, and a lot of people have a problem grasping this. We talk about slower moving averages and faster moving averages. The moving average is always the moving average. But the smaller the time frame you're using, or the smaller the periods, the faster that moving average reacts to price. The slower or the longer time period, the slower it reacts to price. Because if you let's go back to my example on gold. If gold was 1250, 1250, 1250, 1250, and now it jumped to 1300, so we looked at 10 time segments, and we added them together and divided, and we added, just because gold was up just this last period, the moving average comes out, say, hypothetically at 1260. Okay. Now, it reacted a lot faster because if you were using a 50-period moving average, you would be adding that 1250 all the way back 50 periods and just adding the 1300 at the 49th period and then dividing it by 50. So it would have a less responsiveness to the most current prices. So it's considered the longer period, no matter what you're using. Okay. We refer to the shorter period as the faster moving average, and any longer period, whether you're using a 9 and a 15, the 9 would still react faster than the 15. So the 9 would be faster, the 15 would be slower. And there's many types of trading systems that use two different moving averages, a faster and a slower, and the crossovers or the reaction between those two. But understanding what the difference is between a faster and slower. And you can have a slow, a fast, a slow, and a slower, because there's also trading systems that use three moving averages. Now, investors should keep in mind that whether a security is rising or falling in value, there are many different ways that they can generate returns either in its rise or descent. Because when you're trading with ETX and you're trading CFDs, you can sell short or you can buy long. So you can make profit in either direction. And moving averages will help us. Now, understanding the different time periods, not faster and slower, but the time periods that you use. Why would you use a 10 period and not a 20 period? Why would you use a 20 period and a 50 period? Okay. So different time periods. It's worth noting that traders with different preferences may employ many averages of varying length. For example, someone looking to invest over a long term may look at how a security performs over a time frame such as 200 trading days. Or this will grant insight into how a financial instrument that performed in the long run. Now remember, you have two different things. You have your time frame on your charts and the time period using in your moving average. Because if you're using, again, a 1 hour chart, you have every 1 hour you've got a close price. So if you're using a 10 period moving average, you're using those 10 last closes or 10 hours. Okay. If you're looking at a 30-minute chart, you would still use those last 10 closes for a 10 period moving average, but that would only cover 5 hours because your chart was putting a close every half hour. If you were using a 10-minute chart, it would then multiply more. If you're using a 1 day chart and you're using a 10 period moving average, it would then use the close of 10 days. So it's compounded twice. The width of the time period on the time frame on your chart, as well as the time frame on the moving average. Now, for us trading CFDs, the shorter, most of us use 30-minute, 1 hour, 15-minute charts. Also, there are standard time frames that work best for different markets. So an individual focusing on short-term trading might hone in on how a currency pair did during a 20-day window or a 20-period window, as doing so will provide a sense of how the pair performed in a comparatively short period. One more use of moving averages is measuring the momentum of a given security's price, or how quickly it is either ascending or descending. The whole point of determining momentum is that once an asset starts moving in a certain direction, it will likely keep moving in that exact same direction for a while. So if a trader can identify the momentum of security, they can buy or sell that asset and even take out long or short positions on it. To single out this momentum, an investor can look at what a financial instrument did within a short, a medium, and a long-term frame. So, what are the most popular moving averages? In theory, there are an infinite number of simple moving averages. But if you're sitting there now thinking, you know what? I'm going to come up with this weird 46-period SMA, and I'm going to beat the markets. Everybody's tried it all. Okay? And the fact is, the difference between a 46 and a 50-period SMA is relatively tiny. So we try to use the most common. We try not to go out there and try to go out left field and come up with something unique. Also, if you do, you have to back test it, you have to test it forward, you have to do everything, and you're going to find out that it doesn't make much of a difference. Because a lot of times we'll talk about a 9 or a 10-period moving average. You decide which one you prefer. It's not going to change the strategy. So while I do not advocate you following everyone else, it's important to know what other traders are looking at for clues. So let's start. The 5-period SMA. This is for the hyper trader. This is for the guy who's looking for fast results and works good to help you find an entry point once you've made a trading decision. The shorter the SMA, the more signals you will receive when trading. The best way to use a 5 SMA is as a trade trigger in conjunction with a longer SMA. In other words, using a combination of 5 and a 20, a 5 and a 50, a 5 and a 10, and when they cross over each other, that's your trigger. That's how MACD, the indicator, works. Also, a 10-period SMA, and it's very popular. It is about the most popular period for swing traders and day traders alike. Then we have the 20. Now, a 5, 10, and 20 is a great trading strategy. So the last stop of the bus for small short-term traders is a 20-period moving average. Beyond 20, you're basically looking at more primary trends, and they work better for longer-term investors. But we do have a 50 SMA, and it's used by traders to gauge the midterm trends, and it's used as a crossover for day trading strategies, but to look at it just on a chart doesn't help us that much for the type of trading we're doing. Then you can go all the way up to 200 SMA. Now, this is for the world of long-term traders, long-term investors, and trend followers. Now, some traders will tell you to try a simple moving average trading system where you buy and sell if the price breaks the average on a closing basis. Unfortunately, this is not accurate. Oftentimes, stocks will tick above or below a moving average only to continue in the same primary direction. Okay, if that's too simplistic. But now that I've given you just enough doubt before ever attempting to trade with the simple moving average, let's review a few ways to make money. But before we get over there, I want to pull up a live chart on your screen, and we're going to put some quick moving averages on here. Now, we're looking at the Euro-US dollar in a 1-hour chart. Okay? Plain and simple. To put a moving average, we just simply go to indicators, and we can scroll down to moving average. Okay. And I'm going to show you in a minute a little preparation or presentation we have on exactly how to do this on the ETX platform. And you can see here moving average exponential, moving average weighted, moving average cross, all the different ones that we want to do. Okay, so we're going to just click on moving average. And at the same time, while I'm here, I'm going to click on moving average exponential. Okay, so that we have them both up on the chart. Now, let's start out with the simple moving average. And I'm going to hide the other one. Let's put this one in a, let's make this one a bright color. You can see we're going to make this gold, make it thicker. And we're going to start out with a 10-period moving average using the close. Okay, so we have our 10-period moving average. We can see it's already calculated right here. The most, see the little orange numbers where my little hand is pointing to? Okay, up here in the left, that is the current moving average for the current time frame we're looking at. So we can see the euro is currently trading at 113.837, but the moving average is 113.34. We see the gold line going along our charts. Okay. Now that's a simple 10-period moving average. Helps us see what's going on and smooths out the noise in our charts. Now, we can talk about crossovers. So it said when price crosses over and up the moving average, we would be looking to buy. Okay, it's giving us, we're not looking to buy. It's just giving us an indication that price might be rising or it would be starting in an uptrend. Here we broke down here and it came down and we fell below. So whenever we see the breaks, but that's too simplistic to make any trading decisions. Now, we also set up an EMA. And turn that on. Let's make that a bright blue. And we're going to set our EMA on the same 10 periods. Okay, and you can see the difference between the gold and the blue moving average lines here. And you see how the gold is a little bit lower, where the blue is more responsive to that price climb and giving us more information. But that's simply the difference between the two. Now, let's turn this EMA off. Let's put another moving average on here. Okay, and we're going to set this one. We're going to make this one bright red. And let's take it. And we're going to set this at a 20-period moving average. Okay. Now that 20-period moving average is the longer of the two. So we can see here, it is less responsive to price. See how low this one is? That is the 20 period as compared to the 10 period, because one is slower. The red one that we just put on the charts is longer time, slower reaction. Okay. Now, there are whole trading systems that talk about buying and selling, and they're fairly accurate or give you some information when a shorter term or a faster and a shorter moving averages cross over each other. And you can see each time that they do cross, we can see a change in price and direction. And then there is a third, by adding on a third moving average in a longer period, much longer period. So we're going to go add this one on, and we're going to make this a 50-period moving average. And we'll leave this one a blue. And then there is an entire way of analyzing the trend, okay, and whether we're in a strong uptrend or downtrend, and what the momentum is by seeing the variance, not the crossover, but the variance between the distance between the three different moving averages. So it looks like a lot of squiggly lines on our charts, but it's actually giving you a lot of information. So let's go back. And I want to show you how to use these on the ETX Trader Pro platform. And you just set them up so you can set them up on your platform and all the indicators. So let me share with you a quick presentation on the ETX trading charts and how to set these up. So now you know how to set up the indicators on our platform. So you can set them up, and once you know you set them up in your chart settings, they stay forever until you reset them or wipe them off. So once you set up how you'd like to use moving averages, you don't ever have to do it again. But let's talk real quickly about how you can incorporate moving averages into your trading. Well, one, they work as help you see trend direction and filter out trades. Now, the 10 period or 10-day exponential moving average is a favorite indicator to determine the major trend. It's called red light and green light because it is imperative in trading to remain on the correct side of the moving average because it'll make sure that you're on the correct side of the trend. So think of any time the price is above the moving average, it's green, or you would be looking at a long situation. Anytime it's below the moving average, it's red, and you'd be looking at a sell situation. Not a trade, just a situation or an alert. So there's many ways and many combinations. There's endless combinations. You can use a 9 and a 21 EMA. There's all types of gurus out there trying to teach their own little philosophies on what you can use. Now, also, you read about in the papers a lot and see in the news golden crosses and death crosses. Okay. These are formations made by moving averages. So here you can see the golden cross and the death cross. Basically, it's when the price falls above or below the moving average and when a longer period and a shorter period cross over. So moving averages also don't work so well in ranging markets. Remember that. Okay, they work much better in trending markets. Now, Bollinger Bands is one of the most popular indicators out there, and it's completely based on a centerline moving average and calculated from that moving average. So let me pop up a little presentation again. We got lots of little presentations for you tonight on how to use moving averages to include in your trading. So as you can see, the moving average is a multifaceted tool that can be used in a variety of different ways. Once a trader understands the implications of EMAs versus SMAs and the importance of the self-fulfilling prophecy and how to pick the right period settings, moving averages become an important tool in a trader's toolbox. But you should always combine moving averages with other indicators and other interpretation of price action. Because moving averages are a very simple tool, a very helpful tool, but they aren't a trading system. So thank you very much for joining us tonight. And thank you for supporting ETX. And I hope you learned a little bit. And we'll see you next week. Have a good night now.